Inflation is a persistent economic phenomenon that affects individuals, businesses, and entire economies. At its core, inflation represents the general increase in prices of goods and services over time, eroding the purchasing power of money. For investors, inflation poses unique challenges and opportunities. Successfully navigating inflationary environments requires a nuanced understanding of its causes, effects, and the investment strategies best suited to preserve and grow wealth in such conditions. This comprehensive exploration delves into the intricate relationship between inflation and investments, offering actionable strategies for success in both moderate and high inflation scenarios. To appreciate the impact of inflation on investments, it is essential to understand its underlying drivers. Broadly, inflation can be categorized into two types: demand pull and cost push. Demand pull inflation occurs when aggregate demand outpaces supply, leading to higher prices as consumers compete for limited goods and services. Cost push inflation, on the other hand, arises from increased production costs, such as wages or raw materials, that businesses pass on to consumers. Central banks often respond to inflation by adjusting monetary policy, typically raising interest rates to cool demand. However, these interventions can have far-reaching consequences for asset prices, borrowing costs, and overall economic growth. The most immediate effect of inflation on investments is the erosion of real returns. Even if an investment generates positive nominal returns, those gains may be offset or even surpassed by rising prices. For instance, an investor earning a 5% annual return in a year when inflation is 6% actually experiences a 1% loss in purchasing power. This dynamic underscores the importance of considering real, inflation-adjusted, returns rather than nominal figures when evaluating investment performance. Traditional fixed-income securities, such as government and corporate bonds, are particularly vulnerable to inflation. These instruments pay fixed interest payments that lose value as prices rise. As inflation expectations increase, yields on newly issued bonds tend to rise, leading to declines in the market value of existing bonds with lower coupons. This inverse relationship between bond prices and yields can inflict capital losses on holders of long-duration fixed-income assets during inflationary periods. Conversely, certain asset classes have historically served as effective hedges against inflation. Equities, for example, offer partial protection because companies can often pass higher costs onto consumers in the form of price increases, preserving their profit margins. However, the effectiveness of equities as an inflation hedge depends on several factors, including the sector, the company's pricing power, and the broader economic environment. Sectors such as energy, consumer staples, and materials tend to outperform during inflationary periods due to their ability to maintain or increase margins. Real assets, including real estate and commodities, have also demonstrated resilience in the face of inflation. Real estate investments benefit from the tendency of property values and rents to rise alongside the general price level, providing both income and capital appreciation. Commodities, such as oil, gold, and agricultural products, often experience price surges during inflationary episodes, reflecting their role as essential inputs in the economy. Gold, in particular, has enjoyed a reputation as a safe haven asset during times of monetary instability, although its performance can be influenced by factors beyond inflation, such as geopolitical risk and currency movements. Inflation-linked securities represent another vital tool for investors seeking protection. In the United States, Treasury inflation-protected securities, TIPS, are designed to safeguard against inflation by adjusting principal and interest payments based on changes in the Consumer Price Index, CPI. Similar instruments exist in other countries. By incorporating inflation-indexed bonds into a diversified portfolio, investors can secure a measure of real return regardless of future inflation outcomes. Diversification remains a cornerstone of successful investing in any environment, but it takes on added significance during inflationary periods. A well-diversified portfolio can mitigate the risks associated with any single asset class or sector underperforming due to inflation. Strategic allocation across equities, fixed income, real assets, and alternative investments enhances the portfolio's resilience, enabling investors to capture upside potential while limiting downside exposure. Active management becomes increasingly valuable in inflationary environments, as traditional passive approaches may not adequately address the shifting dynamics of markets. Skilled managers can identify sectors and companies poised to benefit from inflationary trends, adjust duration exposure in fixed income portfolios, and tactically allocate to real assets or commodities as conditions warrant. Flexibility and adaptability are crucial attributes for navigating periods of heightened volatility and uncertainty. Understanding the implications of inflation for different investor profiles is also essential. Retirees and those approaching retirement are particularly vulnerable to inflation, as they rely on fixed incomes or periodic withdrawals from their investment portfolios. For these individuals, maintaining purchasing power is paramount. Strategies such as laddering inflation-protected bonds, increasing equity exposure within risk tolerance, and incorporating real estate or dividend-paying stocks can help offset the erosive effects of rising prices. Younger investors, by contrast, benefit from longer investment horizons and the ability to weather short-term volatility. For them, equities and real assets play a pivotal role in compounding wealth over time. Periodic portfolio reviews and rebalancing ensure that allocations remain aligned with long-term objectives and changing market conditions. Inflation also has significant implications for debt management. Borrowers generally benefit from inflation, as the real value of fixed-rate debt declines over time, making repayments less burdensome in inflation-adjusted terms. Conversely, lenders and holders of cash or low-yielding fixed-income assets suffer as the purchasing power of their capital diminishes. This dynamic underscores the importance of prudent leverage and the selection of financing structures that are resilient to inflationary shocks. Geographical diversification can further enhance inflation protection. Inflationary pressures often vary by region, reflecting differences in monetary policy, fiscal discipline, and economic structure. By allocating assets across global markets, investors can reduce exposure to localized inflation risks and capitalize on opportunities in countries or sectors less affected by rising prices. In recent years, the emergence of digital assets such as cryptocurrencies has sparked debate about their role as inflation hedges. Proponents argue that assets like Bitcoin, with fixed supply mechanisms, can serve as stores of value in an era of expansive monetary policy. Critics counter that cryptocurrencies remain highly volatile and lack the track record of traditional inflation hedges like gold or real estate. While digital assets may offer diversification benefits, investors should approach them with caution and limit exposure within the context of a balanced portfolio. Inflation expectations play a critical role in shaping investment outcomes. Markets are forward-looking, and asset prices often reflect anticipated changes in inflation rather than current levels. Central bank communications, macroeconomic data releases, and geopolitical developments all influence inflation expectations, driving volatility across asset classes. Investors who monitor these indicators and adjust their portfolios proactively are better positioned to capitalize on emerging trends. Tax considerations are another important dimension of inflation and investments. In many jurisdictions, investment returns are taxed on a nominal basis, meaning that investors may owe taxes on gains that merely keep pace with inflation. This inflation tax can further erode real returns, particularly for fixed income investments. Tax-efficient strategies, such as utilizing tax-advantaged accounts, harvesting losses, and selecting investments with favorable tax treatment, can help mitigate this drag on after-tax performance. Behavioral biases can also undermine investor success during inflationary periods. The fear of losing purchasing power may prompt impulsive decisions, such as abandoning long-term investment plans or chasing speculative assets. Anchoring to historical returns or underestimating the persistence of inflation can lead to suboptimal asset allocation. Maintaining discipline, adhering to a well-defined investment strategy, and seeking professional advice when necessary are essential for avoiding costly mistakes. Scenario analysis and stress testing are valuable tools for preparing portfolios for inflationary shocks. By modeling the potential impact of various inflation scenarios, ranging from mild to severe, investors can identify vulnerabilities and implement targeted adjustments. For example, increasing exposure to floating rate securities, reducing duration in bond holdings, or adding commodities may enhance portfolio robustness under adverse conditions. Corporate earnings and valuation metrics are also influenced by inflation. Rising input costs can compress profit margins, particularly for companies with limited pricing power. Valuation multiples, such as price-to-earnings ratios, may contract as interest rates rise in response to inflation, putting downward pressure on equity prices. Investors should focus on quality companies with strong balance sheets, sustainable competitive advantages, and the ability to navigate cost pressures effectively. Dividend growth investing offers a compelling approach to combating inflation. Companies with a track record of consistently increasing dividends tend to exhibit financial strength and resilience. Dividend growth provides a rising income stream that can offset the impact of higher living costs, making this strategy particularly attractive for income-oriented investors. Infrastructure investments represent another avenue for inflation protection. Assets such as toll roads, utilities, and transportation networks often feature revenue streams linked to inflation through contractual arrangements or regulatory frameworks. These investments offer stable cash flows and the potential for capital appreciation, making them valuable components of a diversified inflation hedging strategy. In addition to strategic asset allocation, tactical adjustments can enhance inflation resilience. During periods of accelerating inflation, overweighting sectors such as energy, materials, and industrials, while underweighting interest rate-sensitive sectors like utilities and consumer discretionary, can improve performance. Monitoring macroeconomic indicators and central bank policy guidance enables investors to make timely shifts in sector and asset class exposure. Alternative investments, including private equity, hedge funds, and real assets, offer additional diversification and inflation protection. These vehicles often employ strategies that are less correlated with traditional markets and can exploit inefficiencies arising from inflation-driven dislocations. However, alternative investments typically require higher minimum commitments, longer lockup periods, and greater due diligence, making them suitable primarily for sophisticated investors. Liquidity management is another critical consideration in inflationary environments. Rapid changes in inflation and interest rates can trigger market volatility and sudden shifts in investor sentiment. Maintaining adequate liquidity ensures that investors can meet near-term obligations, take advantage of emerging opportunities, and avoid forced sales at depressed prices. Balancing liquidity needs with long-term growth objectives is essential for portfolio stability. Financial planning frameworks should incorporate realistic inflation assumptions. Underestimating future inflation can result in insufficient savings, inadequate retirement income, and unanticipated shortfalls. Regularly revisiting financial goals, updating projections, and stress testing plans against higher inflation scenarios enhances preparedness and reduces the risk of unpleasant surprises. Education and continuous learning are indispensable for adapting to evolving inflation dynamics. Staying informed about macroeconomic trends, policy developments, and investment innovations enables investors to make informed decisions and seize opportunities as they arise. Engaging with financial advisors, attending seminars, and leveraging reputable research sources contribute to ongoing investment success. For business owners and entrepreneurs, inflation presents both challenges and opportunities. Rising input costs necessitate proactive pricing strategies, supply chain management, and cost controls. Businesses with strong brand loyalty, differentiated products, and operational efficiency are better positioned to maintain profitability in inflationary environments. Investing in technology, automation, and productivity enhancements can offset rising labor and material costs, preserving margins and competitiveness. Globalization and technological innovation have altered the landscape of inflation and investments. The integration of global supply chains, advancements in logistics, and the proliferation of digital platforms have increased competition and put downward pressure on prices in many sectors. However, supply chain disruptions, geopolitical tensions, and shifts toward deglobalization can reignite inflationary pressures, underscoring the need for vigilance and adaptability. Central banks play a pivotal role in shaping inflation outcomes through monetary policy. Their dual mandate, typically encompassing price stability and full employment, requires careful calibration of interest rates, asset purchases, and forward guidance. Investors must monitor central bank actions and statements closely, as policy shifts can have profound effects on interest rates, currency values, and asset prices. Currency risk is another dimension of inflation that merits attention. Inflation differentials between countries can drive currency fluctuations, affecting the value of international investments. Hedging currency exposure, diversifying across multiple regions, and selecting investments denominated in stable currencies can mitigate the impact of exchange rate volatility. Insurance products, such as inflation-adjusted annuities and long-term care policies, offer additional means of safeguarding purchasing power. These instruments provide income streams that rise with inflation, ensuring that beneficiaries can maintain their standard of living even as costs increase. Evaluating the features, costs, and guarantees of such products is essential for integrating them effectively into a comprehensive financial plan. Philanthropic endeavors and charitable giving are also influenced by inflation. The real value of endowments and charitable contributions can diminish over time if investment returns do not outpace inflation. Nonprofit organizations and donors should adopt investment strategies that prioritize real returns, diversify across asset classes, and periodically review spending policies to ensure long-term sustainability. Government policy responses to inflation can create both risks and opportunities for investors. Fiscal stimulus, regulatory changes, and targeted subsidies may alter the competitive landscape, benefiting some sectors while disadvantaging others. Staying attuned to policy developments and engaging in advocacy when appropriate can help investors anticipate and adapt to shifting conditions. Technological advances in financial markets have enhanced access to inflation hedging instruments and information. Online platforms, robo-advisors, and data analytics enable investors to construct customized portfolios, monitor performance in real time, and implement tactical adjustments with unprecedented speed and efficiency. Embracing these tools can enhance decision-making and improve outcomes in inflationary environments. Environmental, social, and governance (ESG) considerations are increasingly relevant for inflation-aware investors. Companies that prioritize sustainability, resource efficiency, and responsible governance are often better equipped to manage inflation-related risks, such as supply chain disruptions and regulatory changes. Integrating ESG criteria into investment decisions can enhance long-term resilience and align portfolios with broader societal goals. Behavioral finance research highlights the importance of emotional discipline and long-term perspective in successful investing. Inflationary periods can test investor resolve, prompting reactions driven by fear or short-term thinking. Developing a clear investment philosophy, setting realistic expectations, and maintaining regular communication with advisors and stakeholders foster confidence and consistency in the face of uncertainty. Retirement planning in an inflationary world requires special attention to withdrawal strategies, asset allocation, and income generation. Systematic withdrawal plans, dynamic spending rules, and the inclusion of inflation-protected income sources can help retirees sustain their lifestyle without depleting their assets prematurely. Periodic reassessment of retirement plans ensures continued alignment with evolving inflation trends and personal circumstances. Intergenerational wealth transfer and estate planning are also affected by inflation. The real value of inheritances, trusts, and bequests can erode over time if portfolios are not structured to deliver inflation-adjusted returns. Utilizing trusts, gifting strategies, and inflation-protected investments can preserve family wealth and fulfill legacy objectives. Education funding and college savings plans must account for the rising cost of tuition and related expenses. Inflation-linked savings vehicles, disciplined contribution schedules, and diversified investment options can help families meet future educational needs without undue financial strain. Healthcare costs are particularly susceptible to inflation, often outpacing general price increases. Planning for medical expenses, purchasing appropriate insurance coverage, and incorporating healthcare-specific inflation assumptions into financial projections are essential for safeguarding well-being and financial security. Cultural, demographic, and societal shifts influence inflation dynamics and investment opportunities. Aging populations, urbanization, and changing consumption patterns can alter demand for goods, services, and assets. Investors who anticipate and adapt to these trends are better positioned to capitalize on emerging opportunities and mitigate risks. In conclusion, inflation is an inescapable aspect of economic life, with profound implications for investors. Successfully navigating inflationary environments demands a multifaceted approach that combines strategic asset allocation, active management, diversification, and ongoing education. By understanding the drivers of inflation, assessing its impact on various asset classes, and implementing tailored strategies, investors can preserve and enhance their wealth in the face of rising prices. Vigilance, discipline, and adaptability are the hallmarks of successful investing in an inflationary world. As the global economic landscape continues to evolve, those who embrace these principles will be best positioned to achieve their financial goals and secure lasting prosperity.